And so that is the process that they used to sort of cheat the world system. But this is also the reason that over this time period where China was manipulating back in the 80s and 90s, this is where all of the manufacturing left the United States and went over to China. They bought all of those jobs by manipulating the global economy. Could those be storm clouds brewing for the global economy? Well, over the past couple of weeks, it seems like it's all coming down to China. But to get a really good perspective of what's going on, let's take a look at the past couple of weeks of the incoming news. So this was back in August 14th. These are not in exact chronological order, but the hits keep coming, and we're not talking about like the greatest hits here. These hits are like blows in a boxing match. For China's economy, its July report card missed expectations, and it altogether omitted youth unemployment stats from the announcement. So what do you do in China if you've got bad news? You just pretend it doesn't exist. At the same time, Biden issues an executive order restricting U.S. investment in Chinese tech. So just when they need a whole bunch more foreign cash flooding in to help bolster the economy, a little bit of that has been cut off, not a lot. U.S. stocks slide amid banking fears, weak China data. Moving on, China slides into deflation as consumer factory prices drop. So consumer prices and factory prices. Then, this one's good. China sneezes, but will the rest of the world catch a cold? Now, the reason it's good is they've got some great data here. Here is China's dashboard of disappointment. The reason this is great, at least as far as I'm concerned, is this gives you a broader perspective. This goes back to the beginning of this century. And so what we have here is year-over-year growth. If the line is at zero, it means it may have gone up 10% last year, and then it didn't go up at all this year. So when it falls, it's not necessarily really bad news. It's only if it falls a lot or if it falls below the zero line. That means you've actually got contraction. So the industrial production has been the amount of increase year over year has been falling to some reasonable rates, actually. 3.5, well, a 6% growth. That was great for China then, because they are one of the world's, they're an engine for the world, a big driver. Retail sales, they've fallen down to zero growth. This is really bad news. Property investment, real estate and real estate development and investment accounts for about a third of their GDP. It's just a huge proportion, and it has gone negative. So we're looking at 8.4% contraction, now at 7.7. Fixed asset investments also falling. There was one, and here are some of the rate cuts that are going on. This is the rate cuts for COVID, so the COVID crash. And then they did some more rate cuts in 22, but now they're doing rate cuts again. Moving on. China asks some funds to avoid net equity sales as markets sink. So they're asking mutual funds not to sell so that the market won't tank. And then China Shadow Bank misses dozens of payments, sparking protests. So, you've got deposits at a investment at a shadow bank, and they're supposed to be paying you every month interest or a dividend or something like that, and they miss month after month after month, and you get mad, and all your neighbors get mad, so you arrange a protest. But then the police show up at your door and have a little visit with you and say, your protest may have some negative consequences. And so you decide not to do it. So they actually are visiting investors at home to stop these protests. China's housing slump is much worse than official data shows. Country Garden, this is one of the biggest developers in China, is in danger of default rivaling Evergrande. Evergrande, well, let's just move on because I think Evergrande is next. China Evergrande, the world's most heavily indebted property developer, just filed for Chapter 15 bankruptcy protection. What is Chapter 15? Chapter 15 is actually a U.S. bankruptcy protection that is for foreign companies that owe U.S.-denominated assets, that owe a debt to U.S. debt holders. And so there's about, I think it's $19 billion that they owe in U.S.-denominated debt here. So they've filed in the U.S. They actually defaulted in 2021. Global investors dumped Chinese securities as state support hopes fade. So this asking the mutual funds not to sell, well, maybe that didn't work out so well. China urged buybacks at starboard companies as markets tumbled. Okay, starboard, China's starboard are the 30 largest firms on the Shanghai Exchange. And so they're asking those companies to do stock buybacks so as people sell, that stock goes somewhere, goes back into the company, and the price of the stock doesn't drop. Well, that can be a good strategy if it works. But if they buy it back and the stock tanks anyway, which it probably will, it's a bad strategy. So is it working? Well, I don't know. Let's take a look. This is the long, when I opened this chart, I think it was set to 1 month, and you go, oh my God, this looks like it's falling off a cliff. But then, you take a look at the big picture. This goes all the way back to December 1980. And so we're looking at the entire bull market here of the Shanghai Exchange as far as we've got data going back. And it looks like a really good trend. I mean, if you look at the lows, you can almost draw a line underneath them. And this latest pullback does not look that bad. But take a look at this. If you're a technical trader, you've got a shoulder here, then you've got a head, and then you've got another shoulder developing, and all that has to do is go down and break the neckline. You draw a line between these two lows, and it's predicting, if you flip the head upside down, it's predicting a move down in somewhere in this area of support. But Shanghai Stock Exchange isn't the only stock exchange. Here's Hong Kong, and this looks a lot worse. Hong Kong put in its peak back in January 2018 was the peak for Hong Kong, and it has been pulling back over the last 5 years here. It's not looking very good. China's surprise move on loan rates shows banks are under pressure. China growth hopes fade after modest rate cut. So the rate cut turned out to be not enough to impress the public in China. China's central bank steps up in defense of the renminbi. So now we're talking about a currency crisis, an exchange rate crisis. So they're going to defend the renminbi. Renminbi is their currency, like saying US dollars. When you hear the term yuan, that's like saying cash or bucks. It's slang for renminbi. So China targets yuan bears with most forceful fixing guidance. And so let's see how that's working out. Well, here's the long-term chart. And it really, it looks they're trying to stop a devaluation, I guess, in the Chinese currency. When this goes up, it means the Chinese currency. This is how many Chinese yuan you receive for $1 US dollar. And it used to be, you have to look up here. This is the way this chart works. It works anywhere I put my cursor on it. It's giving you a readout, and that readout isn't the exact exchange rate for that date. This is. So we go back to the beginning of this chart, and you see that it was at 1.59. So let's just say 1.6 yuan for a dollar. And then, as you can see, we have a perfectly free market here. This is what a free market looks like, and it went all. They devalued their currency through market interventions, and made it fall to the point where $1 would buy you about 1.7 yuan. So I'm going to take a little detour here to a really old presentation that I've been giving since somewhere between 2010 and 2013 was the first time I presented this particular presentation on how one country can sterilize currency inflows and the reasons why. So there's China, there's the US, and we're going to explore the trade between them. So here is a retailer in the United States that wants to sell something to a US consumer. And they sell that iPhone to the US consumer, and now Walmart has dollars, but they've got a shortage of iPhones. So they call up the factory in China and they say, hey, we need some more iPhones. And the factory produces another iPhone, and they pay for the iPhone with US dollars. This creates a little bit of a problem for China, and here is why. In order to pay all of their employees and get those dollars out into circulation in China, what they are that business is supposed to do, the bank is supposed to put those dollars onto the foreign currency exchange, the Forex, and buy yuan. And that way, this business can pay the workers in China, and those yuan are in circulation. However, if they do that, there is a glut of dollars on the Forex and a shortage of yuan, and supply and demand sort of rules everything. So if you've got too many dollars, the value of the dollar goes down, the value of the yuan rises, and what happens is trade goes back into a natural equilibrium that it is supposed to be at, but China doesn't want that. They want their population put to work. That was the big problem in China after coming out of I believe Mao died in 1976. And so after coming out of communism, the thing was to get the Chinese population put to work to make them happy. That's how you stay in office without an overthrow, is to keep the population happy and fed. But China doesn't want this trade to go back into balance. They need a cheap yuan so that their exports to the U.S., so that their goods in the U.S. are really cheap, and so that their imports from the U.S. are expensive, so that it's Chinese workers that are put back to work, not the U.S. workers. So this is how the U.S. lost a lot of its manufacturing base. Instead of doing this trade on the Forex, what China would do is the People's Bank of China steps in. People's Bank of China takes those dollars from that local business, and the way they do it is they print yuan and they buy them from the local business. So those brand new yuan go into the banks. But then the U.S. comes up with a bond, and instead of putting these dollars on the Forex, the People's Bank of China sells those dollars to the U.S. Treasury. The U.S. Treasury spends them into circulation, and now those dollars that left the U.S. a little while ago on this trip come right back into the U.S., not causing inflation because they're gone for a little while, then they're back, then they're gone again. However, in China, they're printing brand new currency to replace the dollars that they did not put on the Forex. So there's this buildup of bonds at the foreign currency reserves at the People's Bank of China, and a buildup of yuan in the out in circulation. And this process repeats and repeats and repeats. And the growth of both currencies happens, but it happens with bonds and yuan in circulation mostly. And so that is the process that they used to sort of cheat the world system. But this is also the reason that over this time period where China was manipulating back in the 80s and 90s, this is where all of the manufacturing left the United States and went over to China. They bought all of those jobs by manipulating the global economy. So let's move on from this. I don't even, there we are. This is their total currency reserves, excluding gold. And you see that it topped at about $4 trillion. And the vast majority of this, they don't want to buy any more U.S. treasuries. And so this is flatlined now. But all of this was all manipulation of the global economy. So with here's zero hedge. With China's economy on the verge of collapse, the PBOC central banker, that's People's Bank of China, central banker, calls for helicopter currency. He doesn't know the difference between currency and money, but he's calling for them to print currency. If money has to be a store of value, that means you can't just make it up out of nowhere suddenly. And it shouldn't vanish suddenly. Anyway, and that's one of the Aristotle defined this, that the three primary functions of money are that it must be a medium of exchange, a unit of account, and a store of value. And any thinking economist, any legitimate economist, has backed him up on that store of value ever since Aristotle first said it. But I want to show you something down here because it's interesting. Hence, the only thing that could truly shock and awe markets would be outright helicopter drops of currency direct to households and businesses in order to stimulate dead-on-arrival Chinese consumption. Because all their consumption, you saw the retail year-over-year growth in the earlier article. Impossible, you say. After all, China has nearly 300% debt to GDP, and only the terminal economic basket case that is Japan is higher. This is a Bloomberg article. This is a Bloomberg writer, and he's wrong. And you see here that when you add up household debt, non-financial corporates. Now, why is it non-financial corporations? Because financial corporations, like banks, debt is an asset, not a liability. That's, they own mortgages, they own U.S. treasuries, and that's their asset. If a non-financial issues corporate bonds, that's owed back. Here's the government debt. So the green is the sovereign debt that is owed by China's citizens. The yellow is corporates. The blue is households. Now, I want to show you a page this is a chart from page 88 of chapter 6 of the Great Gold and Silver Rush of the 21st Century. The data here comes from J.P. Morgan and IIF. I can't remember what that is right now. But here is Japan at 6 years. When you add, so that writer just compared total debt to sovereign debt of other countries. So yes, Japan only has higher debt than the total debt of China as sovereign debt, but they're actually all of these countries. There's 6 years of GDP that Japanese and Hong Kong owe somebody, and then Singapore, Canada, Great Britain, Sweden, Euro area, Norway, USA, and South Korea are all ahead of China. But yes, China has more than 300% total debt to GDP, not sovereign debt. So that writer from Bloomberg needs to brush up on some economics. Run it cold. Why Xi Jinping is letting China's economy flail. And this article is great, not because of the article, but because of some of the pictures it has in it. Back in 2013, I went to China to film for an episode of Hidden Secrets of Money that never aired. We never finished putting it together. But we visited the ghost cities in China. Now, the ghost cities that I visited back in 2013 have been filled. But they looked like this back then. There was areas that were deserted. These have been deserted longer. And these are going to fail this time because China is going into economic contraction. But they build an entire city of empty places. And they pre-sell all of these apartments. And this is the reason that it's such a huge percentage of GDP in China, the real estate sector, is because instead of investing in the stock market, most people will own 2, 3, 4, 5, 10, 20 apartments. And yeah, some of those are rented out, but these developers like Evergrande come up with a rendering and a model, and they have a big sale of these apartments that are going to exist someday. And believe it or not, there's one of these right down the street here in Puerto Rico. I get emails from a realtor I dealt with in the past, and they're selling a building. And when I walk past that address, it's an empty lot with a sign says that there's a building coming, but it looks real. You go to the realtor's website, and there are photos, and you can fly a drone up in the air, and you can take a picture of the view that apartment is going to have. You put in an apartment that's completely furnished and everything, and it looks like you're buying something that already exists when it's pure vapor. So this is from that article. The same. So these two, all of these weeds and everything, this is abandoned. All of these buildings are empty. And we visited places like this, like I said. Take a look at this one. The Legend of Sea project in Ningbo. This is Country Garden. And Country Garden is like the one that has missed payments, and they are the one that is next on the chopping block as far as danger of default. They're the danger of bankruptcy. And so Chinese exports suffer the worst fall since the start of the pandemic. And according to Bloomberg, a hard landing is here for trade, roiling world export champs. Okay, so this chart, black is 2022, blue is the first half of 2023 annualized. So you can see that Mexico has gained in exports. Canada lost a little bit, but China is down 25% year over year. That is something pretty horrific. And if you go to page 82 of the Great Gold and Silver Rush of the 21st century, I explain how trade recessions, you can see there's these periods of time where around the world, a whole bunch of diverse economies sort of have semi-synchronous recessions. And what's happening here is these used to be transmitted by trade. The U.S. would have a recession, and then somewhere between 6 months to 3 years later, a bunch of the U.S. trading partners would then have a recession. Why? Because the U.S. isn't buying as much from them during our recession. And then we recover and start buying more, and they recover. And that is here's the Reagan double dip recession, it was called, and how it transmitted. And if you look at this, it happened before all of these recessions. And then it causes the slowing of our buying their goods causes their economy to slow down. But then with the global financial crisis in 2008, it became a super synchronous event. Why? Because it's transmitted around the world through all of these derivatives. And then with COVID, it became a hypersynchronous event. The next one, it doesn't matter where it starts. If it's a big country like China, or if it's, the next recession, when the next crisis starts, it's going to spread and it will be global, and you need to prepare yourself now. I want to thank you for watching, and you're going to see an update on this in the coming weeks and showing how exchange rates and crises and import and export causes one society to be in the spotlight for a decade or two, and then that spotlight moves on to the next one. So I want to thank you for watching. We'll see you next time.